The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. DBS has released its second quarter 2025 CIO report, highlighting growing market volatility driven by geopolitical tensions, tariff concerns, and the rise of AI commoditization. Now, the report notes that U.S. exceptionalism is fading, with a downgrade of U.S. equities to be a 3-month underweight while still maintaining a 12-month overweight. The bank also highlighted risks in U.S. tech, particularly around the so-called Magnificent Seven, and emphasized a shift towards alternatives like gold and private assets for downside protection. In terms of commodities, the report pointed out rising prices driven by stockpiling and supply squeezes, but cautioned that tariffs could eventually drag on global growth. So to dive deeper into these insights, joining me today is Hou Wey Fook, who is the CIO at DBS Bank. Hi, Wey Fook. Thank you so much for joining me.
Yeah, thank you. Yeah.
All right. Well, your report makes one thing clear. It looks like volatility is the game or the name of the game this year. And it's flagged that early on that 2025 wouldn't be smooth sailing. And with Trump's aggressive tariffs, immigration curbs, and federal spending cuts, that call is playing out. I mean, the S&P has reversed gains, treasury yields are falling, and consumer confidence is weakening. So, Wey Fook, based on this report, how much further do you see U.S. markets correcting rather than stabilizing? And is this the beginning of a broader shift in sentiment or more of a short-term correction?
Yeah, so it really depends on the tariff policies, There has been a delay of the announcement, 90-day delay. So we'll wait and see. But until there is certainty in the market, we will continue to kind of be in a volatile market pattern, going forward until things are being clarified. Markets do not like certainty. So we will likely be in this kind of choppy, trading range for the next 30 days or so, yeah.
Well, the report says U.S. exceptionalism is fading, and you've backed up with a 3-month underweight on U.S. equities while still keeping a 12-month overweight. What was the trigger behind that downgrade?
Yeah, so, what's happening today is if you look at the global market, the U.S. obviously trades more expensively compared to Europe, Japan, and Asia. But as we all know, markets can stay cheap for a long time until we see catalysts. Now, we are starting to see catalysts in Europe. For example, Germany has pivoted from their fiscal policy conservatism, and they're going to pump a lot of money to improve on defense budget and also on infrastructure spending. So we think that's a catalyst, and that will help European stocks kind of do a fair, and meaningful catch up with the US in terms of valuation. And in the case of China, we think the play on the domestic consumption remains valid. Chinese government has a lot of levers to really pump prime consumption, given that the leverage or the debt over GDP is only 25% compared to 120% in the US. So we like certain, I would say, sectoral plays or thematic plays like platform companies, large banks in China. So because of that, we, on a 3-month basis, we want to switch some of our exposure back into Europe and Asia.
I see. Well, it looks like the report also flagged growing concentration risk in U.S. tech, especially with the Magnificent Seven continuing to dominate market cap. What's the risk of staying overweight in these names despite strong earnings?
Yeah, so we actually underweight U.S. on a 3-month. It doesn't mean we are having zero exposure to U.S. We do have a lower exposure compared to the benchmark, but whatever exposure we have in the U.S. would primarily be in technology. We think, technology really riding a secular uptrend, meaning long-term irreversible growth trend, and the winners are U.S. technology companies. So therefore, we continue to like them over 3 and 12 months. So really in the U.S., the exposure is primarily technology. And, we definitely are living in a digital world, and, we are seeing innovation upon innovation. And the current one, of course, is AI, and that's still in the early innings.
But could a potential AI commoditization cycle further derail their dominance? Where else should investors look to diversify within equities?
Yeah, so the way we could, kind of build a constructive or a well-balanced equity portfolio will be, we look at it from a growth side of things. So on the growth side, we like the technology play. And then on the income generating part of the equity market, we like dividend yielding stocks. I think Singapore REITs is where we want to feature. Yields are in the order of 5.5% to 6%. The valuations have come off as well. So that's a nice, I would say, exposure to dividend yielding equities, including China large banks.
Right, I see. Well, one of the more interesting angles this quarter was the emphasis on downside protection, urging investors to double down on gold and private assets in the recent report by DBS. Let's start with gold here. It looks like gold is on a tear with near-term support from Trump's volatility and longer-term strength from de-dollarization. How much more room does gold have to run then? Is it still a buy at this levels? And should investors be thinking about position sizing for gold today then?
Yeah, we have been bullish on gold for the last 2.5 years. And the reason for that is because, of the risk of, de-dollarization, so geopolitical risk rising. And that had resulted in actually central banks around the world have been buying physical gold, and you can buying up gold 2 times more than they did in prior years. So we think the underlying support is there. Now, at the same time, we also notice that, holders of what we call derivative or futures contracts, when they expire, they actually are looking to take delivery of physical gold. And, paper gold, is normally many times more than physical gold, right? The supply of paper gold. So everyone thinks there's insufficient physical gold, and that would result in another kind of spike in the gold price.
Okay, well, switching over to private assets as well, it's been highlighted in the report that a 40-30-30 portfolio had lower volatility than the traditional 60-40 over the past 15 plus years. So should investors be rethinking that classic 60-40? I mean, what makes this 40-30-30 structure so attractive, and how should investors think about implementing it?
Yeah, so, private assets would include private credit funds as well as private equity funds. These are really investments into private companies. They are not listed. So we do think that there is a lot of value in there. So really the selection of the manager who's managing that private asset fund is of utmost importance because, they would be able to kind of find the best companies that demonstrate potential. What they normally would do is they would help the private company to scale up, to become more operationally efficient. So they do add value to the private company before that they have it go public and to kind of reap the capital gains out of it. So really, these asset classes do provide what we call uncorrelated return through the value addition that comes from the fund managers. So having private asset exposure together with public bonds and public traded equities, I think would really, make the portfolio resilient together with gold. I think it will make it very resilient against all these uncertainties that we are seeing today, in regard to tariffs.
Well, speaking of another uncertainty here is the AI game, right? I mean, AI has also been something that's been moving markets fast. Then a report noted that DeepSeek's low-cost, high-performance model sent ripples across the tech sector, which triggered a sharp pullback in major AI names. Are we now entering a commoditization phase for AI? And how much of a threat is this to big tech's margins and business models? Are investors underestimating the pace of disruption?
Yeah, I think, the fact that now one can access AI at a very, reasonable price, given all these large language models that are out in the market, actually helps the, technology sector because there will be a broad-based adoption of AI going forward. So we like the play in infrastructure, semiconductor chips. We like the play in cloud computing companies, cybersecurity, automation, robotic companies. So really, the whole AI adoption will broaden out, and that is going to help all these various sectors within AI to do well.
Well, other than all the different assets that we've discussed thus far, what else do you think investors should be paying extra attention to, especially in terms of emerging risks or opportunities?
Yeah, we think, investors should start to deploy their cash. I'm aware that a lot of investors still sit on what we call deposits. Now, the Fed is likely to be cutting rates, because of all these tariffs. we'll have a period of very slow growth. And the Fed has, the dual mandate, and one of which is to really fulfill strong employment growth. So, because of the weakness that they're going to face from all these tariffs, they will likely be cutting rates. So if you're just holding on to deposits, you have this what we call reinvestment risk, i.e. today you're getting 3%. When it matures and you reinvest into a new deposit, you would probably not get 3% anymore. You're getting 1.5%, 2%. So instead of subjecting yourself to this lower interest rate, over time going forward, what we are suggesting is deploy cash into bonds, into shorter dated bonds maybe, and you can kind of lock in a yield that is much better than that of cash rates going forward.
All right. And before we let you go here, we've seen so many moving parts in play this quarter, from Trump's policies, tech disruptions, commodity swings, and so on. What else will you be watching closely in the weeks ahead that could, shift your outlook?
Yeah. So we hope that this tit-for-tat, trade war would cool off. That would be for sure a positive. However, if things really don't turn out, the way we want it or the way the markets want it, what is important is for investors to be constructing or having a portfolio that is resilient. So, gold is good asset class to really help the entire portfolio to stay resilient. And more importantly, also for the kind of securities that the investor is buying, you need to focus on quality. So in the equity side, look for companies that continue to generate earnings growth, has strong product and, kind of superior products and services, companies that has what we call moat qualities, able to defend the profit margin because of their, superiority in products and services. And then on the bond side, focus on investment-grade bonds, not high-yield bonds. So really companies that have strong balance sheets. So I think that's the way to really, be resilient against whatever outcome from these tariff talks.
Some great insights from you there, Hou Wey Fook. Thank you so much for joining me.
Thank you.
Thank you. That was Hou Wey Fook, CIO at DBS Bank. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.